All right, Module 7, raising your credit score. So credit scores measure credit worthiness. Okay, FICO credit scores, they range anywhere from 300 to 850. Okay, so here's how it's pretty much broken up. Okay, and I want to point out there's a difference between FICO and Vantage scores. Vantage scores are usually what you'll see with Credit Karma, most of the credit monitoring companies. FICO scores are usually used by the credit grantors. So there's different FICO scores for buying a house, car, credit cards, and so forth. Okay, so but FICO scores, so you have a poor credit score from anywhere from 300 to 579. People in that range, you're definitely paying a higher interest rate. So it is, I mean, it can cost thousands of dollars in interest rate alone. So that's why it's so crucial to work on your credit, even if you're just increasing the score high enough so you can get into a range where you're paying a less of an interest rate. Okay, so you can save yourself some money as well. Okay, so it's not always just about just removing every negative item. You want to have a plan and a strategy as well. Okay, so you can see right here how everything is broken down. So you have the 5 credit score factors. Okay, so 35% of your score is all about your payment history. If you're paying your bills on time. Okay, are you late? Okay, total amount owed. Okay, how much do you owe? Also known as your utilization rate. That's worth about 30% of your credit score. I will tell you right now, these two things are huge. As you can see, deleting negative items is only worth about 35%. So fixing your credit is more than just removing negative information. Yes, it is good. Yes, it helps. But is it the whole process of credit repair? No. It's just it's a big piece, but it's only a piece. Okay? The other part is how much you owe. Okay? How well do you manage your credit? Okay? This is the other part that lenders or credit grantor or whoever's offering you money, they want to know, okay, do you pay your bills on time? And then the bills that you do pay or do have, how well do you manage them? Are you living on the verge of your credit limits? Okay, are you going beyond your means? How bad do you need that credit? Looks like if you didn't have that credit, you might be, in a big pickle. So at any minute, you could be a credit risk. Okay, because you are tapping into a lot of this credit. So people who are lending you money or granting you credit, look at this. Okay, so 35% is the history. How well or how bad have you been paying on it? 30% is how well you're managing that. Okay, how are you using more than half of your credit limit every month? How low are you keeping those balances? Okay, that's what that means. 15% of your credit score is about the length of your credit history. How long have you kept that account open? How long have you had credit? Okay, so of course people who are much older who've had good credit, they're going to get 15% is going to be huge for most people who've had a long history of credit or account that's been open 10 years, 20 years, 15 years, or credit history that long, entire credit history, you know what I mean? So 15%, how long? Okay, or is it a bunch of new debts, new things? Are you constantly applying for new accounts? Is everything new? Okay, do you need these credit cards? Are you having some troubles financially where you need a bunch of credit cards? So these are some of the things, credit grantors think about. And you have to look at it from that perspective as well, but you also need to know what goes into it, the full picture. Okay, the other part is 10% is the type accounts. Okay, so you want to have a mixture of accounts. So when we say types, are they credit cards, revolving accounts, installment loans, so loans you are paying on, okay, student loans, car payments? Those are different. Okay, so can you manage a car payment? Can you managing a car payment and a house note is a lot different than managing a JCPenney bill. Okay, are you able to manage multiple different types of accounts? Are you good managing, your finances? So having a mix of accounts is good. It accounts for 10%. So even when you're reestablishing credit, you want to make sure you're keeping in mind that you're adding different type of accounts. Okay, credit card, merchandise accounts, store cards, secured cards, CDs or loans, some type of loans, rental credit, a mixture of accounts. Okay, maybe you have a personal loan out there, whatever it is. So you want to have a mixture. Then 10% is all about recent credit activity. Okay. So what has happened recently? Okay, so that's why they say when you're repairing your credit, you want to look at what has been happening on your credit report within the last 24 months. Okay, so from the date it became negative or whatever, you want to focus on those items that have negative history within the last 24 months. Okay, because those are the ones that are the most damaging to your credit. Okay, something that's been sitting on your credit for 3 years, 4 years, or something that, was late 3 years, 4 years, or something like that, or a collection account that's been sitting on your credit literally for 3, 4 years, it's not going to be that damaging as a collection account that just popped on your account a month ago. Okay, so you want to focus on those ones that are within that 24-month range within the last 2 years, because those are the ones that are affecting your credit score the most. So if you want to raise your credit score, you want to focus on those recent derogatory activities or recent derogatory accounts hitting your credit report. Okay, so that's how you're going to raise your credit score. Okay, let's see. So you can see right here how that's broken up. Like I mentioned, payment history is huge, and how well you manage that amount. So those amount owed. Okay, so your utilization, how much do you owe compared to what's left or what's available on that credit card, or whatever limit you have. Okay, so credit score, where do you get it? Okay, so you can obtain your credit score from a credit card, a loan statement, or online account. So if you have an account with, let's say, Chase, Discover, Capital One, or something like that, usually offer these FICO scores as part of their incentive. Okay, usually it's only one bureau though. Usually you might only get TransUnion's FICO score. Now these are not Advantage scores, I'm talking about FICO scores. Okay, so because FICO scores, obtaining FICO scores or FICO credit monitoring, it becomes very expensive, very expensive. So that's why you in the beginning, as you're fixing your credit, you want to focus on the Vantage scores, far as using that to repair your credit. But if you're planning on purchasing a home or a car or whatever it is, you want to make sure when you're close to that target, okay, that you go ahead and get your FICO scores as well for all three bureaus, so you can kind of see where you're at, because Vantage scores, Credit Karma, versus what the banks require for a loan or a car or a credit card is going to vary, and it's going to be off. It may be off 50 points, 80 points, depending on what it is, because different scoring models put more emphasis on their point value for different things. So maybe medical bills, they don't really care about as much as this or that. So the points and the way the scoring is a lot different. Okay, so you just want to make sure you keep that in mind. So you can get the score from a nonprofit credit counselor, a credit score service, a credit bureau or FICO score, or from FICO. Like I said, credit score service, if you're just trying to get your credit scores, your Vantage scores, all three, the credit monitoring company we suggested or mentioned earlier will be just fine. Vantage scores. Okay, but if you want to get FICO, it's totally different. Okay, so like I said, scores from different sources may vary slightly, and it may vary from company. Okay, so it just depends on how that information is reported, when they are retrieving that information, and so forth. Okay, so, and they may be using a different version of a scoring model. So, scores can vary. So deleting negative accounts from reports. So dispute and complaint process can remove info from reports. It can raise your credit score, okay, by removing those damaging items from your credit report, especially ones that have happened within the last 2 years or became negative within the last 2 years. Those are damaging. There are other items that are also damaging, collections, public records, stuff like that. Those are damaging. Okay, so you want to, work on those, get those deleted, and those will raise your credit scores as well. Okay, so if you want to focus on raising credit scores, you just got to be mindful of the type of items you try to delete. Don't just try to delete every negative item, because if it's an account that has been open for 10 years and you were only late once or twice, it's not worth deleting that whole credit history, because as I showed you before, credit history is worth, a nice percentage as well, or portion of your credit score. So that's another reason why your score can drop. So even though a bad item, a negative item like collection can be old, not old, but negative, that the item is negative, you may have had that account for a long time, and deleting it can actually drop your score because it's history. Even though it's bad history, it's still history. So even though it's good to delete negative items, but if you're trying to purchase something big, like a house, car, whatever